Hey, everybody. Good morning. Happy, what is today? Wednesday. I don't even know what the date is, everybody. It is July 29th. Wow. God, summer's flying by. Good to see everybody. We've got a good crowd in. Make sure you grab your coffee. This show is going to be awesome. And because it's going to be awesome, I'm going to get started really quick. Great to see our regulars in here. Sidharhar, Corey, Dan, Veronica. I'm sure Amanda will show up. With that, let's get started. Good morning, everyone. My name is Sam Maule. Welcome to episode 91 of these of the 11FS FinTech Insider Breakfast Show US. In this show, we bring you the best and the brightest from around the fintech and banking landscape every single weekday straight into your homes at 8:30 BST. That's British Standard Time, if you didn't know it. Apart from Wednesdays when I go live at 10:30. If you didn't know that, which you should know because you're watching this, so what the hell. Most important thing, let us know where you're at. So in that comments section, let us know where you're at in the world. I know we've already got Dan in from London, Veronica in Atlanta, wonderful Corey in Louisiana. But give wherever you're at a shout out and click on that share button. That'll go out to your network on LinkedIn. Smack the emojis like crazy. Share this thing and subscribe to 11FS. Okay, first off, 3 news stories from the past 24 hours that caught my attention and should have yours. First one, Lend Academy reports Innova announced yesterday they were acquiring OnDeck for $90 million. Now, please take into account that OnDeck IPO'd at $1.5 billion in 2014. I suck at math, but that's a massive difference. OnDeck has been struggling since the onset of the pandemic, to say the least, as small businesses across the country face unprecedented stress. OnDeck reported in their Q1 earnings call in April that 45% of their loan book was in some stage of delinquency, as they reported a $59 million net loss. They reported Q2 earnings earlier this afternoon, and they somehow managed to eke out a $2.2 million profit on originations that were down 89% from the prior quarter as they suspended new lending. OnDeck CEO Noah Breslow, by the way, who is a really good guy and a good friend of mine and the podcast, he was on the Evano earnings call, and he made the comments that their loan book back in April is actually considerably improved since the economy has opened back up. They've reduced their provisional for credit losses as the future started to look better. A little bit about Evano. They're a publicly traded company primarily focused on consumer loans that was spun out of Cash America back in 2014. Incidentally, one of their brands, short-term lender CashNet USA, was actually acquired by Al Goldstein, who was the co-founder of Avant. Personally, real quick on this, I can't believe a bank didn't acquire them. Again, they IPO'd at $1.5 billion. Could have got them for $90 million. That's pennies on the dollars. You would have acqui-hired an incredibly good team. We know the team in OnDeck, they're great. You actually would have acquired a very good product and a loan book in the SMB space that you might not have had. So again, shocked that maybe like a PNC or a Regions or somebody didn't move in. But hey, I actually think for Evano and for OnDeck, this is a good move. Second story is from TechCrunch. They report TransferWise, a London-headquartered international money transfer services, disclosing that it is now valued at $5 billion by private investors. Confirming an earlier Sky News report, the new valuation represents an increase of 43% since May 2019. It's good to be TransferWise. And is triggered by a further $319 million in secondary share sales. Notably, the new $5 billion valuation doesn't quite make TransferWise the most valued privately owned fintech in Europe. Klarna was first out of the gate in August last year with a closed $5.5 billion valuation. Revolut followed in February this year, right before the coronavirus took hold. TransferWise now serves 8 million customers worldwide, processing around £4 billion in cross-border payments each month across 2,500 currency routes and 54 currencies. The company also recently announced new regulator permissions to offer savings accounts in the UK. Me on this, go TransferWise. They're freaking a good company. And in the early days, I would have gone, when I say early days, like 2014, I would have been like, I don't know if they'll make it. So never listen to me on advice when it comes to this space. And finally, The Independent reports an incredible story about Mackenzie Scott. The former wife of Amazon CEO Jeff Bezos has donated almost $2 billion to good causes since her divorce. In a blog post on Tuesday, Mackenzie said she donated $1.7 billion of her wealth in the past year to causes including racial equality, LGBT rights, public health, and climate change. A lot of that money went to historically black colleges, by the way. The news comes after Ms. Scott last year committed to donating the majority of her fortune after a split from Jeff Bezos, which left her with a 4% stake in Amazon. My take, in a very nice way, this is a great middle finger. I mean that politely, since Mr. Bezos is with everyone else in front of Congress today. And Good for you, Mrs. Scott. That's all I can say on that story. All right, today, let's get our guests, and I'm thrilled to be joined by Abb, Kapoor, and Dave Potter from Curu. I believe I said that right. Curu Credit. On today's show, we're going to talk about how they're working to create a more inclusive credit system in the U.S. Guys, how you doing? Abb, you're in Denver, and Dave, I think you're in Denver too?
Yeah, you've got it. So I'm actually in Maryland right now. My sister just got married, but heading back to Denver in the next few weeks.
So how was the COVID wedding? Gotta ask.
Different. I think, they could have decided to postpone it for a few months. They might do a small ceremony when gatherings are able to, be back in place. But it went really well, and she's really happy. That's all that matters.
All right.
Definitely weird, though.
Yeah, we're living through strange times. And everybody who is jumping in on that, it's good to see you. So again, guys, you got folks. Dr. Abdullah's on from Saudi Arabia. Hey, Dr. Abdullah. We got Dan in London. We got Gene in Boston. You got a lot of the U.S. covered, so you got a good audience, guys. And Sidrahar, I know you're on. I didn't look back in the stream. Feel free to go out and ask incredible questions. Let's see if we can stump these two guys. Good luck on doing that. So I like that you gave Maryland a shout out. So let's talk a little bit about one. Let's start with the company. Let's get to the important stuff. What is y'all's mission? What do you do?
Yeah, absolutely. So our mission is to eliminate credit rejection. At a high level, and how we characterize that is Curu. We have a solution, and we integrate with banks and lenders to enable them to improve the bankability of their applicants and recover their rejected applicants. So a little bit more simply, if you guys have heard of Apple Card's Path to Apple Card, if someone would apply and would typically get rejected because their eligibility would be lower than what would get them approved, is it puts them on a plan to get approved within, say, immediately to the next 5 months. We have a solution like that integrates for other banks and lenders to help people get approved.
So the background story is what I love. Okay. And by the way, when we're done with this, I got a whole bunch of introductions for you guys because I've suddenly seen a million places where you have a product fit. Here's why I love you guys' story. And I'm going to let you talk about the origination story for the company. But to put this into perspective, everyone on this is our group watching this knows I got a bunch of kids, so 4 kids total. So I've had 2 go through college already. I got my 18-year-old daughter, whose bedroom I'm in, is about to go off to college. Well, would have been, thanks COVID. We'll be going off to college in 6 months. That experience of going off on your own at a young age and then living in a dorm and knowing you don't want to live in a dorm and then try to go in an apartment sucks. It's hard. And if I'm not mistaken, that's how you guys met, right? Was that college?
Yeah, you got that exactly right. So Abb and I met as freshman year roommates over in Maryland at the University of Maryland. Abb was studying computational finance and electrical engineering.
Of course you were, Abb.
So huge on the algorithms. That'll definitely play into kind of the insights that built into Curu. And I was studying finance and marketing, and we were both on full-ride scholarships. So I guess at the time, our freshman year dorm, it was a forced triple, which means it was enough space for one person, but they forced 3 of us there. And It was like a triple bunk bed situation. It made no sense, and there was no AC. So we had to get out of there the next year. And that was on exactly what you were saying, Sam, where we're applying for off-campus housing, off-campus apartments. I'm trying to figure that out. And we really found ourselves between a rock and a hard place. In our situation, we didn't have established credit. So we just out the gate got rejected. And it wasn't just for one off-campus apartment. It was for every single housing opportunity that we applied for. So, we were really stuck. We're like, what do we do? So from there, we kind of realized that it was because we didn't have established credit. And we then began to ask friends and family, how do we get started? How can we properly build credit? Because, a lot of times people will open up that first line, they end up getting rejected, or, there's just a lot of rumors around credit. So throughout that, we learned more about credit. We're able to establish our own credit scores and get housing, but really began to then build up a passion around better understanding and helping people with credit. So we are in certifications in credit counseling, and this is kind of where this began to spin up towards some of the insights that we were seeing at this point. I don't want to dictate this part too much, so Abb, if you want to trail the rest of that, feel free to pick it up.
Yeah, so we started working with students and their parents. Originally, our goal was to help educate students, but then we recognized students didn't really care too much to be just generally educated or platforms for financial literacy, and really wanted a little bit more. The way I'll say it is they wanted it done for them, and then also to have the rewards of what was done. So what was becoming hot was robo-advisors. So Acorns was coming into play. Robinhood was popping up. And so we didn't know that we were kind of building towards a robo-advisor, but we essentially ended up building algorithms around what we were learning, both from our certifications and directly servicing clients around how to basically reverse engineer the credit score based on your financial position to show you kind of what steps you need to take to be on the best path towards improving your credit score and financial standing towards your financial goals. So originally, again, it started working with directly clients. I think we got to around 300 clients that we were working with directly. And then that transitioned to finding a way to automate that and save ourselves a little bit of time. I mean, having that many clients and being full-time students with double majors is pretty challenging. So that's when we decided to put it into an algorithm, and then thus kind of the first iteration of Curu was born.
You know what I find fascinating? I mean, correct me if I'm wrong, guys. So Dave, I know you got a full ride to the Bill Gates Millennium Scholarship, right?
Mm-hmm.
All right. It's terrible that Bill Gates is trying to kill us all with COVID too. You know, just amazing that the dumbass people out there. And Ab, you had a full ride. You both were getting a full ride at Maryland. Great school.
Yeah. Yes. So it was
Here's what drives me nuts. If I got two folks that are getting a full ride at a school like Maryland, and what is it you studied again, Ab? Go ahead and say it, because I can't remember.
Computational finance and electrical engineering.
Okay, the odds of me wanting to give you a loan, SoFi, right? When I'm looking longer term at your earnings, I'm just going to go ahead and say it. I find it fascinating that you guys, and I get it because I've been in the industry. I understand the whole thing. Has anyone ever compared y'all to Facebook except good? See, and I'm guessing that your first number of customers were at the University of Maryland, right?
Yeah, absolutely. And
okay.
That was like our inevitable goal when coming into it. Then we saw kind of Facebook turn into an interesting public perception, but we wanted to be the Facebook of finance. But that was when we were on the consumer front. Within the last year, we transitioned and ended up selling the software as an enterprise solution to lenders, but definitely wanted to become the Facebook of finance.
Yeah, and I like Corey LeBlanc. So Corey's a Chief Digital Innovation Officer at Origin Bank, Louisiana. He said, look, having a 19-year-old and a 20-year-old still living at home, I can confirm they want it done for them and not just instructions. Corey, if you take a look at what Ron Shevlin, if you guys don't know Ron Shevlin, you should know Ron Shevlin. Great writer at Forbes, great analyst at Cornerstone Advisors. But he says this all the time. We talk a lot about financial education, and he goes, I hate to break it to you, most people just want it done for them. Amen. Right. I mean, they just do. Right. As busy as we all are, you want to focus in on what you're good at. So I get what you guys are doing. Did I read this right? You walked away from your scholarships to go to an accelerator. Is that right?
You've got it. So
how did your parents take that? Just out of curiosity.
Yeah. So we kind of warmed up to it. I think there's kind of two stories I think we can go at. I think I've been signaling it for a while now. It wasn't. Wasn't that by any means, I knew that was going to be the case, but was always pursuing, the biggest calling your opportunity. So from freshman year, Abb and I were, trying to figure out something to do in our extra time together. Always working on a business or something like that. Well, not always a business, but trying to, figure out what that next big thing would be. So there was one time where we spent, maybe in our sophomore year, but we spent the summer in an RV in San Francisco. And it was completely overpriced. It was advertised as like a quaint RV. So it was like, again, this was like a forced double. This was like no space. And it was $3,500 for the month, which made no sense as well. But we're staying out in San Fran, just made it out to the valley. We're, just meeting with a bunch of, whether it was like investors, network out in the area, other founders, and kind of we're just dipping our toes there. And just like really fell in love with the area, fell in love with like Stanford and so much out there. And when we were like beginning to catch our flights back, we happened to like barely miss our flight, and I took that as an omen. And I happened to call my mom. I was like, I think I should just stay in San Fran. Like, I'll just like, figure the rest out here. Like, I'll transfer schools or something. And she, she didn't like hearing that. And so therefore, like leaning towards, the point of leaving school. I think Abb and I, though, did it very appropriately. We were, there was a big opportunity that I think made sense in us going to North Carolina. And one thing that rallied up with that as well was, about a month prior to that, we were participating in our school's biggest business competition. And our friends, family, whole community were there, and we happened to like place first for that. And I think that allowed our family and everyone to like really see that vision. So that was a really, in our sense, like almost a graduation. So in many senses, I think, Abb and I continue to, look forward and evolve. And thankfully, we're at a point now where, I think our families as well can look at it and think it was a fine choice.
Yeah, my parents are both immigrants, so they both come from India, and leverage education as a way to advance in their own lives. And so education was something that they cherished, and I think that they didn't understand it at first, but I think that the pitch digman competition that we participated in school, and seeing us on stage and seeing how much we were genuinely in love with not what we were doing, but the problem that we were trying to solve, it all clicked for them there. And I think that was when I really got their blessings to go ahead and do this. And we talk about it pretty often, that they're happy that I did. They inevitably want me to go back to school, but I don't think that's going to happen.
As a parent, I'm just going to leave it alone, guys. Bless you. Bless you both. I'm going to leave it alone. I'm not going to let my daughter watch this. So you guys did Queen City FinTech. Big shout out to them. Good friends of mine. And then, obviously you move forward with this. I read that you finished a seed round worth $3 million in May. So closing out a seed round. Well done. That's a good seed round, $3 million. And you decided to actually set up office in Denver. Why Denver? And why not Maryland?
Yeah. So in a bit of the background story and solution that Abb was mentioning, we started off as a consumer solution, a consumer app. We had that in the App Store since about May of 2018. And we were seeing early signs of success, a lot of organic traffic and traction. But one thing that we were noticing is just the blurred lines between, having a consumer credit solution, even if we were, a unique credit building solution. Again, it was still competing with NerdWallet's Credit Karma, and the positioning didn't seem perfect. Whereas with the current evolution that we've described of integrating with banks, where people usually have that pain point of getting rejected and converting that experience to giving everyone a path to approval, we saw as much more refined positioning. But in getting to that point, in 2019, about June of 2019, we gained an investment from FIS into a pre-seed round of funding. And we also gained an investment from Techstars in the Western Union program that brought us out here to Denver. So in that 3-month period, which is really a boiling pot because we were kind of between Arkansas and Denver at the time, is we were able to close out, I guess at that time, our pre-seed round of funding, but then also validate our B2B transition. So we spoke to over 100 banks at the time. We're really listening to the pain points that we had. And that was where we discovered that banks are rejecting a majority of their applicants, typically for factors such as the credit score or other eligibility. And then on the other side that we were very familiar with is consumers didn't like getting rejected. A lot of our consumers were building up their credit score to get a loan or a credit card, for example. So at that point, we combined those, we closed out our pre-seed round of funding, and we largely had a remote team at that time as we were, navigating just the earlier stages. But every time when our team was together was when we identified we were at our most powerful. So in closing that round, we wanted to identify where our best area to grow and set our roots were. And that was clearly Denver. It had an amazing business ecosystem, amazing investors and support system, amazing talent. And then you can never go wrong with the nature, the mountains, skiing and all of that, just right outside the neighborhood. So I think the whole team fell in love with the area.
I love that you were looking at Arkansas and Denver. I don't think people realize the volume of talent in Arkansas. Thank you, Walmart. But just a massive amount of tech talent in Arkansas, by the way. So they deserve a shout out. I would have picked Denver over Arkansas. No offense to anybody who's on here in Arkansas. Corey, I think you're the closest person to Arkansas that's on here. You also have some investment from, I'm going to get their name right because I haven't met these guys yet, but I've read a lot about them. Harlem Capital. So that's cool. Good for you guys. All right, I got to jump to questions because I've been hogging this whole show because they're coming in because I find this to be fascinating, guys. And by the way, the shift to B2B, I could give you a hug, right? Direct to consumer is incredibly hard. You guys know that. So for me, good shout out. All right, first of all, I got to go to Dr. Abdullah in Saudi Arabia. I love that Dr. Abdullah is always on here asking you great questions because he focuses on cybersecurity in the oil and gas space. But hey, he asks great questions. So here you go, Dr. Abdullah. His question is, do you build your own risk modeling algorithms, and what are the challenges you faced in terms of accuracy? He meant credit risk modeling algorithms.
Absolutely. Yeah. So we actually are, for the time being, working within the constraints of existing lending models. And the reason that we're not building our own proprietary models is because of the risk associated. We would be taking on the risk of any defaulted loans, on top of the fact that for financial institutions to change or even evolve their models, it's expensive and risky. They know that these models have a specific accuracy percentage that's worked for them historically. So for right now, we aren't building our own proprietary models to either replace or go along with existing models, but we do have alternative data and behavioral data on top of financial transaction data that we're able to provide the financial institutions that we're partnering with that they can take a look at. And if they want to leverage that data in their risk models, they can do that. So for the time being, we're not advertising ourselves as a alternative credit score because it seems like that's been a valley of death for a lot of companies. But we're working within the constraints and basically have the reverse engineering algorithm for their existing lending criteria, and then showing the lender where they fell, the borrower, where they fell short, and then the exact steps that they're going to take in order to get approved.
Yeah. So another question building on this is from Sid Rahar. Hey, Sid Rahar, man, miss you, dude. He's a company founder out in San Francisco. Hopefully, not paying $3,500 a month to live in an RV. I did the math on that, guys. Jeez, how long were you out there?
It was about a month
and a half.
Okay, still. Oh my God. Come to Florida, $3,500, man. You'd be living in a mansion on the coast. You'd probably get COVID. All right. So Siddhar asks, how durable are your methods to help borrowers improve their credit score? Which is a good question. And let's just start there, right?
Yeah. So we focus a lot on the resilience of their bankability or borrowerworthiness. So even though we focus a lot on credit score, a lot of the actions that we're recommending focus on actual behavioral changes, and that's what we're measuring over time. So some of them may be low-hanging fruits, so I'm going to the light end of the spectrum, and that might be screening of the region that they're in or their annual income. Things that are really high-level factors, and if you don't cover Arkansas or Oklahoma out of the 48 states you cover, then we may immediately screen that, for example. Now that being said, going on a little bit more of the actual side towards behavioral changes, one thing we recommend is our smart payment system. So usually when people are paying off their bills, you may default to paying off the minimum or maybe just the whole amount, for example, and maybe that's not feasible. What we allow is for applicants on here in the actions to be recommended specific amounts that they can afford to pay because we're screening their spendable income. And doing this allows us to be a more effective way in them reconciling their debt, being more responsible, and also improving their credit score at the same time. So that's one of those actions that we have there. And we also look at other things as well. If they have a credit report error that they didn't know how to dispute, we help take those procedures and steps as well. So ultimately, the way that this works is we're screening typically for things such as, say, their credit score, credit report, and bank data. And that's giving us the profile of where they are now. And again, with integrating with what our partners have, we're creating that path to streamline them to getting towards that goal. But again, primarily focusing on the behaviors rather than just the factors alone.
Yeah, it's interesting, isn't it, that this is a space that really hasn't changed much over the past couple of decades, and yet now we're suddenly seeing moves like Experian's partnership with Netflix. If the audience is familiar with that, Experian is now allowing you to put your Netflix pay history in as another deciding factor. They're the only one so far that's done that, but it's interesting that a specific company has partnered with one of the major credit bureaus to do this. I kind of get it from Netflix standpoint, right? It's all right. How many people are pirating their relationship? Which is, I think it's estimated at 44 million people. By the way, everybody, I heard that stat. I was like, holy shit! No wonder they're doing that. But alt data to improve this is interesting. A good question from Tim Naughton: how early do you subject new predictive data to fair lending security or scrutiny, and how often do you scratch data based on the review? Good question.
Yeah, so we're always looking in terms of model updates and how we're screening that. So always looking at model updates and even from challenger banks and alternative data providers. So we're staying on the latest of that, but I would also mention towards what Abb mentioned, the way that we're spearheading our model is for a lot of banks, again, changing compliance can just have a higher risk threshold. So leaving that towards Experian and them integrating Experian Boost. We think initially they'll continue to spearhead that and slowly integrate additional data. As we're taking those steps to help banks and lenders approve of more people in thresholds that they're already comfortable with and have the underwriting models to approve of them safely and have that underwritten. In that same time, we're taking in data, the schools that they're going into, their bank data, regional data, and at the same time, that's where we're feeding that in towards our models and therefore able to find those opportunities to additionally lend. That's more so going to be, again, as we approach, say, that Series A and let a bit more data feed through the system as we get towards that more of the data modeling approach.
Can you guys talk a little bit about, real quick, so we're running up against the hour. So again, a B2B targeted approach, which was a good shift, by the way. I would have highly recommended that. And I'm glad you guys went there. So if I partner with you, say I'm a bank, right? And I go and I partner with you, or I'm, anybody that's offering credit along those lines. What's the integration like? And if I read this right, you guys do have something like an approval dashboard that you provide. Can you talk a little bit about the relationship with your customers, how it works?
Yeah, so we have a white label or API integration. So seamlessly, let's say you're applying for, if you're a partner of Capital One and you're applying for a Capital One Quicksilver credit card, and say the minimum credit score that you needed, I think right now with COVID requirements, it may be around a 720, but maybe your credit score is a 690. So reason why it's also 720, like COVID boosted a bunch of requirements. So maybe you have a 690, you're not going to readily get approved for the Quicksilver. The status quo right now is you would just get a rejection email, and that would be the end of the experience. Right. With our integration, it's just baked into the lender's experience. Instead, you're immediately seeing actions that you can take that would be automated to help you bridge that path to approval. And typically, the length we're seeing here is anywhere from immediate, so there's sometimes just some quick fixes that can be screened, and ultimately, it may be within about a 5-month period.
And
go ahead.
Sorry, one thing I want to mention on the integration standpoint is we look towards being under the brand of the financial institution or lender that we're working under. So basically able to service them before you're able to bank them. And part of that is because a lot of consumers don't want to be sent to third-party services in order to work with them at that level. And so if we can do that under the brand, there's less drop-off, but more specifically, it's providing a better experience than just the status quo rejection email.
I say this constantly, man. There's nothing wrong with being under the glass. Right. Actually, that's where the money is, everybody. I'll just flat out tell you that. And I don't mean that as I do mean it to some extent as a capitalist, but still, that's a great business model to have. All right. Believe it or not, we're up against the clock. So got a ton of different banks that are in here watching this. Where's the best place for folks to reach out to you guys and learn more?
So on our website, CuruCredit.com. If anyone's interested in a demo, there's a quick form that they can fill out, and then one of our service representatives will reach out to schedule one. And then also directly to myself and David. We're both on LinkedIn, so you can catch us on there or reach out to us. It's just Abb and Dave or David at CuruCredit.com for our emails. Perfect.
All right, and folks, if you can't get enough of me, I can't believe my producer wrote that. Hannah, really? I'm being Will Ferrell, and I'm just reading script. If you can't get enough of me, we are launching a brand new video show. The show's called Sam's Breakfast Brief. It's a 4-minute roundup, and 4 to 5. I stretch it long. The most notable news stories of the day. We'll put this out 4 times a week. So we had one go out Monday and Tuesday. I'm going to shift the format a little bit for Thursday. But every day, be on LinkedIn, and we'll post it around 8:30 a.m. Please sign up to that. Give me feedback. The feedback has been great. And make sure you just follow 11FS on LinkedIn. It's the easiest way never to miss anything. And we've decided that one breakfast show per week doesn't cut it, because y'all complained a whole bunch, and thank you all for that. So from the 10th of August, I'll be back twice a week on Mondays and Wednesdays. My daughter, Alex, thanks you for that, because that means she has to get her ass out of bed by 10 a.m. every day. Well done, everybody. All right, so tomorrow I won't be here, but Simon Taylor, who's been filling in for David Barrow Week, will be joined by a name I can't pronounce from Project Imagine. I think they purposely schedule people's names I can't pronounce on the day after, so I have to read it. But hey, they look really cool. Everyone, thanks for being here. Great comments. Guys, thanks for being here, and we'll see everybody next week.
Sam, a pleasure. Thank you, guys.
Amazing. Thanks, Sam. Thanks, Sam.